Well, would you look at that? Xpeng Motor stock is up over 47% after having reported what many would consider a disastrous earnings report. And with the insane macroeconomic headwinds facing China, today's earnings report was more impressive than it was doubtful. But as usual guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, let's address the elephant in the room, which is the fact that Xpeng stock was up almost 50% on November 30th. This actually stirred up a lot of conversation on social media where many people thought that there was some sort of insider trading going on, resulting in the stock being up so much, even though the earnings report was not that impressive. Well, even though I don't like taking credit for investments so early on, I do have to say today's move only validates my investment thesis in Xpeng Motors. It proves to me that Wall Street was indeed undervaluing Xpeng stock over the past 6 months, even though yes, the fundamentals deteriorated significantly. And when the company forecasts Q4 deliveries to go down by around 47 to 52% and the stock being up over 47%, it shows you the stock is indeed extremely undervalued and most of Wall Street was mispricing this investment in the short term. Because guess what? The stock price is already down over 60 to 70% since the highs that it hit in June at 35 bucks. So a lot of this pain and fundamental deterioration was already priced into Xpeng's valuation. And as an investor, that is simply how you make money. You buy when things are undervalued and you sell them when they're overvalued. And with the pace that Xpeng's been innovating over the past year with the launch of the Xpeng P5, the G9 SUV, and its own autonomous driving software, there is no doubt in my mind that the innovation spurred by Xpeng will translate and transform the Chinese EV market forever. And I've been already very vocal about this over my last few videos covering Xpeng Motors. Their products are some of the highest value products you can get in the market. Not only do they offer cheap pricing, but they offer high features, high quality, and also high comfort, as we've already seen from the multiple reviews that have been released for these cars. Now obviously the economic situation could change, but given where the state of China is right now and the sentiment around Chinese equities, the risk to reward in Chinese stocks is unmatched according to any other equity in the market. But obviously that is simply my sentiment based analysis, so now let's dive into my numbers based analysis around Xpeng and understand why the earnings report was a lot better than many people actually think. As you can see, Xpeng missed both revenue and EPS estimates from Wall Street. But the reason the stock is up is because all of this was already priced into the valuation. When the stock is down 70%, Wall Street is already expecting a completely disastrous earnings report. And it gives you no edge as an investor to continue betting on the fundamentals when the valuation simply does not deserve to be down to such levels. And the simple reason why Wall Street loved Xpeng's earnings report is the fact that their gross margin went up by almost 300 basis points to 13.5%. And as we all know, this is a leading indicator of the efficiencies that Xpeng has been implementing in their manufacturing process and the pricing power that they have for their customers, which is exactly what Wall Street actually cares about. This is actually very impressive because this 13.5 figure actually matches with NIO's gross margin in their latest quarter, which is obviously a company that tends to sell higher gross margin products like SUVs, whereas Xpeng right now has mostly been selling compact sedans and sports sedans like the P7 and the P5. And like I already predicted many months ago, the G9 will start realizing revenue very soon, and as a result, Xpeng's gross margin should start going up. And even despite all the macroeconomic headwinds in the Chinese economy and the volatility around the real estate market, Xpeng is still expected to grow year-over-year deliveries by around 56% and grow revenues by another 30%. And when you start accounting for the fact that Xpeng's charging network has only expanded since its last earnings report and the fact that they've only started recently launching their navigation-guided pilot autonomous driving software, you're starting to realize that a lot of economies of scale are starting to be set in place today for future returns for Xpeng shareholders. Yes, things can obviously change in the short term, but the stock market is always forward-looking by around 6 months. So right now, Wall Street is trying to understand where Xpeng will be in the spring of 2023. And chances are, with the massive increase in gross margin, Xpeng is going to start seeing big pricing power and potential easier profits in 24 and 25 as they approach break even. And that is obviously not even accounting for the fact that the Chinese economy itself is also recovering from a recession, and we all know that the best time to buy investments is always during times of recession because the expansionary bull run that follows them is always monumental. And guess what? The number one thing holding back so many US investors from investing in Chinese equities, which is COVID-0, is on the verge of being lifted in 2023. Yes, COVID-0 has damaged China's economy, but it is a good measure to take place to prevent disease from spreading within communities. It is not something the government is doing purposefully to hurt its companies. Instead, it is simply a way for the government to prevent further damage to China's economy in the long run. And as we all know, COVID is short term. We've already seen that play out in Europe and the US, where COVID-19 is pretty much non-existent. And that is going to be a similar case with China, which is obviously a much more energy dense and population dense country than any other country in the entire world. And as a result, we'll probably have a longer time getting rid of COVID completely. And it's these kinds of macroeconomic driven valuation compressions that offer the best investment opportunities in my personal experience. The only reason Xpeng is down 85% is because of the slowdown in the Chinese economy and the rising interest rates around the world. Well, guess what? We know that these things are all temporary and have nothing to do with the fundamentals of Xpeng's business. And the company itself has been very adamant at taking action to respond to these kinds of changes. They've already set up an internal restructuring where they're already planning to cut spending on non-core areas like R&D and external research. And Xpeng's president has only reiterated their guidance for being free cash flow positive in 2024, which is obviously what Wall Street truly cares about. And for those wondering why Xpeng's deliveries collapsed in Q3 and are going to do so in Q4, well, the simple answer for that is because a lot of their sales were pulled forward in 2022, where they more than doubled deliveries in June. I already mentioned this in my video a few months ago. Xpeng's deliveries in the first and second quarter were monumental and were outpacing any single one of its nearest competitors, which means that people bought their EVs a lot earlier from Xpeng than any other automaker, which is exactly why it's no surprise that Xpeng's deliveries are going to go down in Q4 given the macroeconomic situation. And the simple reason why I've been continuing to be an investor in Xpeng stock is because I saw this short-term look that Wall Street had, the simple idea that Xpeng's price to sales valuation was much lower than its nearest competitors, with the NIO trading at 3.35 and Li Auto trading north of $4. And so the bottom line is that it's all these factors combined that determine my investment thesis in Xpeng, and today's earnings report has only validated and strengthened my argument, which is exciting if you're a shareholder for 2023. But obviously guys, things can obviously change, so make sure to do your own research before making any investment decisions, and let me know your thoughts down in the comment section below.